All right, welcome everybody. And this is the fourth day of our Institutional Trader Series. Today we have a really special event with Scott Pulcini and Dr. Brett Steenbarger. You may have read the book from Dr. Brett, who showcased Scott in there and featured him as one of the top performing traders, and how he became such a good trader. Anyway, let's move on here to the disclosures and some other details, and then we'll get going with the webinar. General disclosure: all Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Risk disclosure: trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. The agenda for this webinar series has been about trading size. And what better people do we have today as Dr. Brett Steenbarger and Scott Pulcini. And why we're doing this series is so that you can learn and apply some of these tips and tricks into our CME competition that we're holding next week. We'll give you $1 million to trade in sim. That's enough to get you in trouble and have to learn how to trade some size, as you will slip the book against yourself. So you can sign up at competition.bookmap.com, and it starts October 29th, but we'll also give you access at October 28th. Anyway, you can read through the information here. We have some other news. If you want to join our beta programs, email us at beta@bookmap.com. We have lots of new add-ons, multi-account, market pulse on the web, and others. Our Blue Jacket competition is ongoing. It started October 10th for content. And then later today, at market close, we'll have our Bookmap Academy meeting where we will review your content and your trading activity and give you feedback. All right, so here's the event. We have these two very experienced and knowledgeable traders know about the industry and trading. As you know, Scott is streaming with us for a number of years now, proprietary trader. He's got loads of experience, and in fact, during the years of 2002 to 2005, he was responsible for about 10% of the S&P E-mini volume, and now focuses on both equities and futures, and has expertise and scalping abilities as well. Dr. Brett Steenbarger, trading psychologist and performance coach. He has an incredible amount of experience here. Has been coaching and recruiting traders and hedge fund portfolio managers since 2004. Author of several books, including Trader Psychology 2.0, Psychology of Trading, and this is the one that showcased Scott, was Enhancing Trader Performance. And the Daily Trading Coach, also on Wiley. Shares much of his work via his blog, Trader Feed blog. And at its best, psychology is a bridge between the real and the ideal. He views coaching as a resource that can help bring people closer to their ideals. So thank you so much for coming, and we'll turn it over to you.
Thanks, Bruce. And thank you, Brett, for joining. I think it was about 4 years ago last time you got on one of these with me.
It's been a while.
Yeah. I've heard you've been a little busy.
Just a little bit, yeah. Working with multiple hedge funds at this point, and also some prop traders. So it's kept me plenty busy, but it's also exposed me to different markets, different strategies, different ways people make money. So it's been quite an education also.
Yeah. So, I mean, for those of you that don't know my story, I was started back in early 2000s and went to the trading firm, Kingstree Trading, and started there. And back then there was no education for futures trading because everything had just gone to the screen or just beginning to go to the screens. It was basically sit you down in front of a computer and you got to figure it out or you're out, right? So the very first day I lost $2,500 trading one lots, which is very, very hard to do. It wasn't like I was holding the positions either. I was in and out. That is, try trading one lots and losing $2,500 and tell me how hard that is to do. So I was almost fired my first day. Struggled for months. I didn't make money, and I didn't have one winning day in 2 months. I don't even know how I made it through that. And the owner, Chuck McElveen, was a very good guy. That's pretty much why, or else I would have been booted in a heartbeat. Otherwise, I'm sure. And then one day, it clicked. It was after 9/11. They shut down the markets, and I started trading the German DAX and the Bund overnight because there was nothing. The U.S. markets were closed for that week, and I started to see some patterns, some tendencies, and then when the U.S. Markets opened back up, I started to apply those methods to the ES, and it was just overnight, and I just knew I had it. I knew it so well. You got to remember, like I said, I was about to get fired, right? And I just was starting to make money, and not a lot of money. I mean, relatively trading terms, right? I was making $500 to $1,000 a day, something like that, and I had the gall, or other words could be used, to go in the owner's office and make him a bet that I would be the number one trader the following year. This was 2002. He almost laughed me out of the office, but we ended up making the bet, and I ended up winning the bet. I beat out the Big Cheese. That was the top trader at the time, and the rest was history. I had about 3 years of incredible profits. I made about $15 million for my firm and myself, and then overnight it literally disappeared. And this was right. So Dr. Brett had asked me, so he joined our firm. If you guys ever seen the HBO show Billions, it was just like that. He was the trading psychologist, right? And I started talking to him, which I sorely needed, and a lot of traders need to this day. And I really needed him at that point, because that's right when I started going downhill. But he had asked me, he was writing this book, Enhanced Trader Performance, and he asked me if he could sit behind me for a period of months just to see what made me special, or why, not necessarily my execution, even though he would try to watch what I was doing. He'd have no idea. I'd be flipping in and out of positions the whole time, and he'd just be like, I have no idea what you're doing. But he wanted to just see what made me successful, or what made me elite. Back then I would videotape all my trades and, didn't go over them that night to see what I didn't see. And you got to remember, I was watching just order flow at the time. So I always talk about making trading simple. It doesn't get more simpler than just staring at the order book. And that's all I did. So I was very successful doing it. So he sat behind me, wrote the book. And then right when the book came out is basically right when I started to go downhill and couldn't make a dollar anymore. So it was, that was pretty short lived. And then I spent the next 6-7 years trying to readapt my style. And I just, for a longer term, because I couldn't compete with these algos, I was one of the fastest clickers in the world, but I wasn't as fast as a computer. And I just couldn't figure it out. I had to leave the business 2013, go into medical sales in the doctor's office, waiting to, kiss their ass, trying to sell them something. I was selling genetic testing. So then fast forward to 2017, 2018, Dr. Brett calls me out of the blue, said, hey, I don't know if you've seen this Bookmap software, but it kind of reminds me of when I sat behind you and the way you viewed the market with the orders and the heat map and so on and so forth. And I'm like, I have not heard about it. And the minute I saw it, I'm like, I'm back. Right? Like it was just like when I figured it out with the in the ES the first time, when it's like overnight, I said I had it. And the minute I saw this, I knew I was back. And that was before the SI indicator, which we'll talk about. But thanks to Dr. Brett, he introduced me to Bookmap, and the rest is history. I've been, back in the trading game ever since. And now I'm an educator as well. I have my own trading room, and, I'm born to be a trader, and this is what I'm meant to do. So thank you, Dr. Brett, for showing me Bookmap.
Awesome. Yes. They were different tools back in the King Street days. You remember, we would look at the dome and we'd be able to visualize what's being transacted. But different tools help us process information quickly. And that's always been one of your real strengths, Scott, is the ability to use those tools, recognize patterns very quickly, and act on them really quickly.
Right. Yeah. So it's been, by the way, I'm long NASDAQ. We can go over this trade here and ES in a little bit. But yeah, that was one of my gifts, right? So it was like, I know to this day, you still talk about trading to your strengths. And, I still have the fat. Well, that's why I'm able to watch. I have the bandwidth to watch 20 markets now. So I'm more positional trading now, where I'm holding things, which has taken a long time to be able to adapt to that type of mindset. But the way now I'm utilizing my fast processing speeds is watching multiple markets at one time. So it's probably not fun for a lot of viewers when I'm on my webinars and I'm jumping from market to market to market. But I'm trying to show them, one, like we were talking about before the webinar, instead of pigeonholing yourself into one crappy market that's doing nothing, you can branch out to these other futures markets that are it's all the same game. It's all the same, playing the games with the order book, that these big traders that we're going to talk about. And you were saying how some of your firms, they jump from stock to stock. Well, it's the same, you go to the stock that's the play of the day or whatever. It's the same thing with these futures markets. There's no reason to pigeonhole yourself into one market when it's just horrible trade.
And Scott, if I could just jump in here, one of the things I've learned working both with shorter term traders at prop firms and then hedge fund managers who are trading over longer time periods is that a big part of performance is what you trade, not just how you trade. Being in the right areas of opportunity makes all the difference. And that's really what you're talking about by following all these markets simultaneously and jumping from one to the other where you see opportunity setting up.
Right, exactly. So, that's where I've applied my processing skills now. I'm too old to be in and out, in and out, in and out. Mentally, I'm just done with that type of trading. And just because it's so draining. Algos are 90% of the trade these days. And it's like, you get these pockets where the big money comes in, and that's where that's where you can see on the SI indicator with the icebergs and things like that. But 80 to 90% of the trade is algos. And I have no interest in playing games with the computer back, just in and out all day long. You churn your account, you're mentally drained. So it's still not easy watching position tradings come back and forth. That's why, I gravitated to be a scalper in the first place, because I can't stand watching the whipsaw. So it definitely has been I had to condition myself for that aspect of it. But I would, that's why I tell people all the time, I would love to scalp, right? I love making $15 million. I would love to do it again. If it was that easy, I would be scalping, right? I personally can't. And I always say, you show me someone that does this consistently for 6 months a year, I want to meet them. I can't say, I'm not saying it can't be done. I'm just saying it's very, very, very difficult by hand, right? If you can, you make your own programs to do it, that's fine. But by hand, clicking a mouse, it's very difficult, in my opinion.
Totally agree, Scott. And the people I see who are very successful, they're not doing it by trading micro time frames. But what they are seeing are occasions where there will be, let's say, selling, and suddenly the market can't go down. It's being held up. And you've got all this selling pressure leading up to it. And the skilled traders recognize that those shorts are going to have to be covered, that there are people trapped. And a big part of the game, particularly for the shorter term traders, is figuring out who's trapped where and positioning for the unwind.
That is the exact crux of my trading to this day, right? So that's all I talk about. It's the core of trading, right? Volume drives markets. Price does not drive markets. Volume drives markets, right? So perfect example of, sellers coming in right now. They try to hammer this market lower. You can see these market bubbles, sell bubbles. And actually, I need to adjust this zone, but you can see this big buy ice came in, a big player, 1,000 E-minis here and another close to 700 here. So you got 1,700 buy ice that came in when guys were being aggressive. So what do you think these guys that just were aggressive in this area, what are they feeling right now? They're feeling, oh crap, this would be me in the day, right? So when I was trading size, I would get the same inkling. I would sell as many as I could in this area, and the market would spin in place, and I'd be like, uh-oh, I'm in trouble. And then it would start doing what you're seeing right here, and then I'd have my hand on the button ready to puke. I'd be praying it would come back. Basically every day I'd pray to God if it came back, I would never do that again. And then if it came back, I'd be peeling out, and we actually have a trade for that exact movement. or else I just be puking out. So that is the crux of my trading, looking for these areas that, with this new enhanced, it's not new, it's been around for almost 8 years now, this enhanced CME MBO data that shows these big players, there's someone on the other side of this trade. So no matter what this big player is doing, whether they're hedging options, whether they're getting out of a trade, I don't care. All I know is this area is important. And all I know is that when the market moves away from it, you get these extended reactions. So that is my edge in the market nowadays.
And being able to visualize it helps you act on it more quickly, which makes good sense. Now,
right.
one thing, and maybe we'll talk about this more in detail later, but one thing that's very important for viewers to recognize is that those same dynamics that you've been talking about in the moment-to-moment markets intraday, those are going on over longer time frames because the active investors, the hedge funds, have expanded significantly. More and more money has gone into the various hedge fund strategies. So now it's not unusual that a team, a hedge fund team, a portfolio manager, and the people working with the portfolio manager would be managing $1 billion. Just that team within the fund. And the fund consists of many different teams. So you have all of this money chasing a limited number of markets and opportunities. And once again, what we find is that people get trapped. But now it's happening over longer time frames. But it's really the same dynamic as what you're describing, Scott. And if you can identify people getting trapped on those larger time frames, then you can see some opportunities setting up that will be swing opportunities, bigger picture opportunities.
Right. And then when it comes to that, the larger time frame stuff, I mean, one, you can mark up these, like for instance, there's been buy icebergs in here all day long. You scroll back to the beginning of the day, these bigger entities are not looking for a couple ticks, right? So they're all right for this going down, 20, 30 points and then buying some more. But you can see here, it's been nothing but buys. So it would behoove a trader to mark this area on their chart for when this area moves away, because I will promise you, whatever way it moves away from here, when it comes back, you're going to get some kind of reaction. So the point is, bigger picture, one way you can do it is mark up these icebergs over the longer period on individual days and mark them on the chart. And then then this stuff is, there's basic technical analysis, but this is the same thought process as far as, markets are in two states. They're either balancing or they're trending. They're balancing or they're trending, right? So when markets are balancing, it's traders placing bets. When one of the sides is wrong, they puke them out, right? So that it's very simplistic. I understand. I can promise you, the simpler you make your trading, the better you're going to do. Like I said earlier, I made millions of dollars staring at the dome. I didn't even have charts up at the time, right? So this is a bigger picture way for me to understand, okay, there's lots of bets in here. When this moves out of here, let's take advantage of it, right? And then we drill down to the real-time volume events with the SI indicator, the icebergs, and the stop runs, and we have rules for trading those where we can get in these trades based on the bigger picture. So that's how I judge it. So with these bigger funds, like what are they, in your experience, like what are they trading off of? Are they trading off of an opinion, off of a thesis, off of relative weakness or strength? Like what is like a main theme for them?
Yeah, good question, Scott. So there are really for a larger time frame participant like a hedge fund, there are really two separate processes. One is called idea generation, just figuring out what the idea is, where there's opportunity. So to give a very simple example, Tesla, the stock, came out with earnings, and the earnings were particularly impressive when you broke them down by where the earnings were coming from. And much of the earnings were coming from the energy component to the business, energy production. And so that was perceived as unique opportunity. And now someone could say, okay, this is now a good risk reward opportunity. That's the idea generation. The execution of the idea is really a separate process. So once we have this idea, how can we get it? How can we turn the good idea into a good trade? How can we find points where our reward relative to risk is going to be significant? And that's where the kind of pattern searching that you're talking about, Scott, is so relevant. If something has been trading in a range, we like it for fundamental reasons, and now it breaks out of that range. Now I have a good risk reward opportunity to buy it, and I can limit my losses if it goes back to the bottom of that range, let's say.
Right. I had something I was going to ask you and I forgot.
Oh, a big idea, Scott, is that no matter what time frame you're trading, a good trader knows who they are making money from. You have to know how the other side thinks and behaves. And that's really what you're mapping out here.
Right. Exactly.
Once you understand the other people think, how they behave, you can then see where they're going to get excited, where they're going to be trapped, where they're going to puke, et cetera, et cetera, et cetera, et cetera. But you always need to know who you're making money from.
Right. Yeah, and again, I mean, you can see right here the games that are going on right now. So this is NQ, right? So this is the game I used to play, as you watched for many a day, sitting behind me, right? So it's displayed here now. But I would put up, and of course, it looks like nothing in here, but relatively, this is a lot of size. That's why it looks so bright here. But I would just load up the order book with 1,000, 1,000, 1,000, and then I would start accumulating down here and buying. The whole idea just to push. I want to get long, and then I would save some bullets. And then as I would see the market get close to my resting offers, I would then just step on the gas with any bullets I had left, and it would cause this flurry of activity. And then traders would see the activity and they jump on my coattails, and it push the market right into my orders, my offers, and I'm out of the trade, right? And then all the retail traders are left holding the bag because it was just one game that I was playing, right? And it's like that wasn't real buying per se. I'm out of the trade. Then it's like just sitting there in a vacuum, and then the thing will come back, right? So it's like I like telling the story of how I was hated throughout the street at the time, and even my own firm, because I was just manipulating the market so bad. So back then, spoofing was legal. You can play all these games, right? So I wasn't doing anything illegal, but it doesn't mean people liked what I was doing, right? Because I was playing that game. I mean, I tell a story too that one time I was walking to the bathroom at King Street. I heard some guy cussing me out in his office. I opened the door and I put my head in there. I'm like, did I do something wrong to you? He's like, oh, sorry, man. I thought that was you in the market. So I was hated at my own trading firm for playing these games all day long. The other story I like to tell, and I know you remember this vividly, there was another player in there that was bigger than me that used to eat my lunch most days. This is what started my downfall, right? I'm not going to name the firm or the trader, but he ended up being a huge market manipulator later on in mid 2000s or 2015, 2016. He got fined by the CME and everything else, but he was playing games. I still to this day think he was doing some legal stuff, but that's beside the point. The point is this particular day he had just run me over. I think I lost like $400,000 in like a minute, and I literally, I was at my breaking point. Back then I was a young punk too, right? I was breaking screens and just stupid crap like that. I was very immature, but I literally got out of my seat and I said I was going to this guy's firm to basically kill him. And Dr. Brett and the owner of my trading firm had to physically accost me at the door so I would not leave the firm to go kill this guy. So you remember that one, Brett?
I vividly remember that. Yes.
You're like, what did I get myself into here? I didn't know that these traders were this psycho.
Yeah. But it really illustrates how we can get so caught up in market movement and P&L that frustration can take over.
Right.
And so instead of being proactive, we end up being reactive.
Exactly. And I mean, it's all part of, being mature, meaning you've got to learn to deal with your emotions. And I really think, for traders out there, for your books that you've written, and I know you got another one coming out, but this market environment right now is very, very, very trying, right? Like, I mean, very trying. My trade room hears me bitch about it every day, right? And that's the other thing too. I do less dumb things in the market as far as irrational things, but I will talk and bitch all day long. I mean, even if I'm by myself, because, and you remember back then, Chuck McElveen used to make fun of me. People would be walking by my office and say, "Who's in there with Pulcini?" And Chuck would say, "Oh, it's his imaginary friend." Because if I don't talk it out, my head would literally pop off my shoulders. Like, I mean, so that's just me continuously. That's how I, get it out of my system. Your other hedge fund managers and things like that, the guys that you deal, how do they deal with the stress of markets like this or bad trading periods? Like, what do they do besides try to leave the office to go kill people?
I haven't had any do that, but the hedge fund game is very different because in a hedge fund, you're not trading positions, you're trading a portfolio. And the portfolio consists of a number of different positions in different markets. The whole idea is to find opportunities that are different from each other, that are unique, that are non-correlated. You're looking for diversification. And so they're placing many bets simultaneously, and any one bet is not usually a gigantic part of the portfolio. So they can have ideas not work out, but other ideas, other trades within the portfolio can be profitable. That balance in the portfolio gives them some psychological balance. They're not getting overly caught up in any one trade.
Right. So, but my question is, so how do they know it's actually balanced, right? I mean, you see, like, for instance, bonds for so many years would trade opposite of stocks, and then in a period they would do everything stocks would do. Like, how do they actually know it's actually balanced, right? Where they're not going to just blow out the firm if it moves against
them. Yeah, good question. So they're tracking correlation as closely as you or I would track price action.
Okay.
They're looking moment to moment, hour to hour, day to day, how correlations are evolving. And if correlations are starting to go toward one, if things are all starting to trade in the same direction, the same way, then they start to take their risk down because there's more aggregate risk within the portfolio.
Got it. And do they have like algorithms that tell them this, or are they doing it by?
Yeah, they have tools. They have tools that are that the team members build, and it's on a dashboard, and they can see in real time how correlations are behaving, how volatility is behaving.
Okay. And then my other question is
tweaking the portfolio.
Right.
Yeah, but my point psychologically is that by having that diversification and by being able to tweak and manage the risk that way, it's a way they manage themselves psychologically.
And what kind of pressure do they have as far as performance? Like, what's their drawdown, or what are they allowed to lose percentage wise before they get either put on the bench or booted from the firm?
Yeah, that'll vary from fund to fund, but you're allocated a certain amount of capital. These days, certainly, if you lost 10% of that capital, you could be at risk of being shut down. But the other risk is that at a hedge fund, the way that you're compensated is that you have a salary plus a discretionary bonus. Plus a guaranteed bonus. So the guaranteed bonus is a fixed percentage of what you make after expenses.
Okay.
So the salary is actually a relatively small part of the potential total compensation. So if they're running a book of, let's say, 200 million, and they make 10% in a year, that's 2 million. If they're guaranteed bonus is 15%, then they're going to bring home $300,000.
Right.
So there is risk in terms of how much they could lose, but there's also risk if they don't make a certain amount, then they're not going to get paid that bonus.
Right. Interesting.
Yeah, so it's a different game in that respect.
Okay.
Now, what a shorter term trader, like you and I grew up with at King Street, Scott, achieves that diversification sequentially rather than simultaneously. So if you're trading different patterns, different markets at different times, and you're not trading max size all the time, then in fact, over the course of a day, and certainly over the course of a week, you're trading many different things, and you may be trading them in different ways. And that sequentially gives you the diversification.
Got it. Right. And that leads us back to what we were talking about branching out to other markets and not staring at, one or staring at or trading one or two markets, branch out to grains, branch out to, energy or gold or bonds. Right. And that's the great thing about what I'm doing or what I'm looking at or how I view it with this, the stop iceberg information, the CME MBO data. It doesn't matter what market you're trading. I can show you every market out there, it reacts the same way to these events, right? So it's like this is soybeans for today. Sell ice market falls apart. It's just like it's across the board. Here's bonds. You had dumb money puke market. This is one of my 6 distinct setups. Dumb and dumber. It's like it doesn't matter as long as you know the thresholds for the markets, meaning the amount of size traded that makes a difference, right? So obviously in NASDAQ is a lot different, the size traded versus ES, right? If you were to see 2,000 buy ice in NASDAQ, the thing would rip off the page, right? Like, once it started moving away from there. ES, it's a lot, but it's not like earth shattering. So you got to know your individual markets. But yeah, it's the same patterns across markets because it's based on volume and traders that are trapped. Someone's right, someone's wrong. And that is the whole crux of what I'm doing, right?
And Scott, I think there's an important psychological component to what you're describing. If you're looking at many different markets and you're looking at opportunities across a variety of uncorrelated markets, you're more likely to find good opportunity each day. And you're less likely to get frustrated because things aren't moving, they're not setting up, et cetera, et cetera, et cetera.
Right. Exactly. So another question I have, I see you talking about this a lot on, you reposted something the other day about understanding the overall market environment, like when, whether it's going to lead to actual breakout or it's just a head fake, like one sector's just, it's like the lone sector that day versus everything else is doing nothing versus everything going at the same time. What sectors do you watch or do you recommend traders watching to kind of help them understand, like, say ES starts ripping here, and then you would look over and see, well, 5 of these sectors aren't doing anything. I'm going to get out of some of my long here because I know this is not a correlated move between all the sectors. You know what I'm saying? Like which ones do you look at that you think are the most important, or how many out of, how many will you watch? And then how many would you want to see moving together to stay in a trade longer type of thing?
Yeah, great question. Now, in equity markets, there's an important distinction between trending markets and rotational markets. And in recent years, we've seen a lot more of the rotational trade. So
Yeah, tell me about it.
the institutions will be buying growth sectors and maybe selling value sectors, or they might be buying interest rate sensitive sectors like real estate and utilities and selling other sectors that would not benefit from moves in rates. And so they're trading one thing against another thing and placing money in relative terms. So if you're not following those sectors, it may look like the overall index is going up or down, but in fact, the directional movement is more a function of the rotation to certain sectors. Once you see that, then you can track those sectors with ETFs and identify their patterns.
Are there any particular ETFs you recommend though? Like as far as what are the main ones that you would watch if you were trading today or overall?
Well, for liquidity, certainly the major S&P ETFs. So XLF for financial, XLC for communication, XLY for consumer discretionary, XLE for energy, et cetera, et cetera, et cetera. So you could break it down that way, and those trade with a reasonable degree of liquidity. One thing that I do in my own trading, and this is different from what the hedge funds do, so take it with appropriate grains of salt, is I track the breadth of action for within each sector. So I'm looking within each sector, how many stocks within that sector are trading above a moving average, below a moving average. How many are making new highs or new lows? And that's across different time frames. So what happens is when capital gets allocated in a relative way, in a rotational way, you'll see the breadth of a sector break out relative to the breadth of the other sectors. And that ends up being a very helpful momentum signal.
And what moving averages do you watch? Like the 50-day, 200-day? What's the main ones that you watch?
Yeah. So with the breadth information for the bigger picture, I'm looking at how many stocks trade above and below their 3-day moving average, 5-day moving average, 10-day, 20-day, 50-day, 100-day, 200-day.
That's it?
Yeah. So that's for the bigger picture. And then, of course, intraday, then I'm tracking where they are relative to very short-term moving averages versus longer intraday averages. One of the indicators that I like in this respect was developed by John Ehlers, E-H-L-E-R-S, and it's called the adaptive moving average. Ehlers is well known for his research. He's a quant. He's an engineer by background, and he has tools that chart cycles within markets. And it turns out that if you can track the cyclical activity of a market, you'll catch a lot of the relative strength, relative weakness, and catch some of those rotations. So his average system looks at when short-term moving averages cross above or cross below longer-term moving averages. Right. So you get a buy. Okay, yeah, obviously. So, but the length of the moving averages varies by the duration of the cycles. So when the cycles are trading in a lower frequency way, then the moving averages move out. And when they're trading in a more choppy kind of way, then they collapse in. And so it adapts to the conditions of the market. And I found those to be helpful intraday tools.
Interesting. I'll have to look him up. You know, I don't like adding a bunch of stuff to my trading, but I mean, certain things, you know, so I tell my room all the time. I mean, if someone comes to me and says, check this out, which I've done with a number of things since I, you know, started with my trade room, I will look at it. I just don't throw things into my trading haphazardly. But I mean, if I see something works nonstop, I want that in my trading. So, you know, what you're talking about sounds very interesting. So I'll take a look at that. So what's your take on the biggest rage, which I do believe, and I talk about all the time, and I do webinars with them, the options complex, right? So, you know, showing the S&P options are one of the biggest in the world, right? So, and it really, what I try to stress is, yes, you know, because why this is so effective is because these dealers aren't positional traders. So when you know they're loaded up with positions, they have to hedge with futures. So you know these areas where they will be participating, and many times that's the support, that's the resistance, right? So if you can correlate those areas with the real-time volume, right, the stop iceberg stuff that I look at, or any area that you're looking at, that's an edge in itself, right? So what is your take on that? Do you have any hedge funds that actually use that information? Things like that.
Yes, portfolio managers use that information because increasingly options markets have become the tail that wags the market dog, you know?
Exactly.
Yeah, and so seeing how the positions are arranged in the options gives them a clue about sentiment. It gives them a clue about who's going to have to buy, who's going to have to sell, if there's adverse movement. The relative pricing of options, what's called skew, ends up being a very helpful indicator. You've got, recently we've had a fair amount of skew in the pricing of equity volatility, the VIX index. Expecting volatility going into the US presidential election. And so knowing how people are positioned can be helpful in thinking through those issues about who would get trapped where and how could you benefit from that.
Yeah, I mean, again, I've never really paid attention to it, and the more I learn about it, the more I see these markets. I mean, you can see some of these levels on my chart, and you know, I'm looking at the real-time option flow from spot gamma. He's got this, and he's got the hero. I put a big trade in from yesterday. We caught a trade that, you know, the hero turned up ridiculous. Like, so he has 1 billion notional of options trades is usually significant. Like it turned up like 3 billion in minutes. The market just ripped like 30 points. So it's definitely, they are a major player. What I try to stress is, you know, some days, like for instance, yesterday on that whole move down, the early move down, the hero was just kind of spinning in place. So it wasn't the options dealers that were causing that. Somebody bigger was coming in and unloading, you know, more program selling. So you've got to understand, yes, most of the time it's the options dealer, especially in this crappy market environment, they are running the show. But, you know, I can guarantee you some guys got smoked yesterday buying the dip when thinking, hey, oh yeah, the hero's not going. I'm going to buy right here. I'm going to buy right here. I'm going to buy right here. I mean, the market got killed. And then then, you know, like they must have been done doing their business, whoever came in there, and then the market ripped with the hero. But they're not the only player in the market, right? That's what I try to stress. You know, the dealers are not the only player in the market.
And Scott, there are a couple of questions in the chat that I'll just address quickly. Okay. One person is asking what value sectors are. One of the factors that we learn about in finance is growth versus value. Growth stocks are stocks or industries that are growing, where you can expect higher earnings over time. Technology companies would be a typical example. Value stocks or value sectors are ones that hold up well during periods of economic weakness. So a growth sector might be consumer discretionary companies that thrive in good economic conditions. A value company or a value sector would be one that stays pretty stable regardless of the economic environment. So, for instance, necessities, people buying groceries, that's going to stay pretty stable whether we're a little stronger or a little weaker in the economy. So one of the ways of breaking down shifts in the allocation of capital for the hedge funds is how much money are they putting into value, expecting maybe a weaker economic environment, how much money are they putting into growth, expecting some economic expansion. Now, one person asks, how do the most successful traders start their day? What's their daily routine, taking breaks? It's a really good question. One of the biggest problems, one of the most frequent problems that I come across with the folks I work with is burnout. And so having activities planned during the day that get you out of the screen, out of the market, and that give you energy ends up being important. So it's very common that traders will engage in exercise, physical activity early in the day, get themselves going. They take breaks during the day to clear out their head. As you know, Scott, I worked for many years full-time at a hedge fund, and the well-known founder of that fund had his daily calendar, and it was mapped out every 15 minutes. And every 15 minutes, he would have blocked off, here's his time to talk with analysts, here's his time to go to the gym, here's his time to be trading, et cetera, et cetera, et cetera. So being super organized and super balanced in his calendar helped him be organized and balanced in his mindset.
Interesting. Yeah, that's not one of my strengths. I need to be better at that. But I have been talking about a lot lately as far as taking a break. The 10:30 to 12:30 period. So back when we were at King Street, that's when Mr. Big would start, manhandling me, because that's when the big money from New York starts to go to lunch, and then Chicago follows, and there's really no big money in there. And that is the same thing nowadays. That's when the algos just start to have their heyday in whipsawing traders, because they know no one's going to come in and run them over most days unless there's like some news headline or something. So I try to stress to my room. I mean, I still fall victim to it. I even had to say the other day, I'm like, I am not trading between. This was so funny too. I said this was Monday or Tuesday. I said I am done trading between 10:30 and 12:30 unless the relative volume is spiking, 200, 150%, 200% or more. Then I'll consider putting on a trade. The very next day, yesterday, I'm sitting here. I scheduled a call. And I missed the entire sell-off, and it was on huge relative volume because it was between the 10:30 and 12:30. But that is an outlier. Overall, I have lost millions and millions of dollars, and I'm not just talking the equities. I don't care what market it is between those time periods. It's just you're just asking for trouble most of the days.
Totally agree, Scott. I'm sure you've heard of the card game poker.
Yeah.
You heard a little bit about it. Yeah, but how do you win at poker? You don't win by betting big on every single hand.
Right.
And there are a number of hands that you just muck. You're not going to bet. And a big part of success is knowing when to hold them, knowing when to fold them, and being willing to not play. And I think that's what you're talking about during those market hours. I'm just not going to play. I'm going to play when I have my best edge. And that gives you control, and that translates into a psychological edge.
Absolutely. You just got to be able to follow that, right? You can't say it and then the minute the thing starts moving around, you start clicking the mouse, right? So you got to be very disciplined. And again, trading is not an easy profession. That's why most people fail at it. I mean, it takes a lot of mental work just as something as simple as this. Like, that sounds so easy. Oh, yeah, I'm just not going to trade between 10:30 and 12:30. I'm not going to trade it during this time period or whatever. It's a lot easier said than done if things start whipping around. Like, you've got to, if you're going to stick to it, you got to stick to it. So that's again, it could be very difficult mentally sometimes, kind of like these markets right now that I'm watching.
Exactly. Now, there's another question about what are the biggest pitfalls traders have when they're trading size. And I would say and then they ask, how did Scott overcome this? And so I'd like you to answer that, Scott. But from my perspective, the largest pitfall is that traders try to grow their size too quickly. And they go, it's like going from 10 miles an hour to 100 miles an hour. They try to expand their size too much. They're not psychologically ready for the volatility of the P&L movement.
Absolutely.
And that unhinges them psychologically.
Absolutely. I mean, I started out, that's what I try to tell traders too. Like when I started at King Street, I was trading one lots. As I said the story to start the webinar, I lost $2,500 in one day, my very first day trading one lots, right? But once I started becoming consistent, I was trading ones and twos. And the pattern I was doing, it was like a 1 or a 2. Then I went up to 2s to 4s, 4s to 8s. So I have to go in every week, 2 weeks or whatever, as I was making money, and go to the owner of the trading firm and say, hey, can I have my size? Can I have my size? And he would say, absolutely. And I was doing it gradually. It wasn't like I said, I was trading one lot and then went in and said, hey, can I trade 100 lot, right? Because there's no way, like you said, like you start looking at your P&L with a 100 lot on versus a one lot, you freeze, because you still, this another thing you got to condition yourself as a trader. You can't look at money like it's real world money, because if you do, you just fall apart. You're like, I just lost a car. I just lost my house. I just lost a whole house here, right? So it's like there's so many different aspects of that. If you want to trade size, you've got to, like you said, you've got to build up to it, because there are very few people on this planet that can go from trading ones and twos to 200 ones and 100 and 200s, right? It's just not, it's against human nature, right? So especially when you think about it in real life terms.
A great point. There's a comment about being disciplined in life, that sometimes we can adhere to discipline in our trading, but in fact, being disciplined in life helps us avoid burnout. So if we're doing many different things in our personal lives, if we're engaging in activities that give us energy, then that carries over to the energy that we bring to our trading.
Right.
150 contracts.
But yeah, I mean, I just overcame it. Back to the original question, I overcame it just because I just gradually built up, and I had confidence in what I was doing, and then I knew it was scalable. I know if it worked with a one lot, it would work with 10 lot, it would work with 100 lot, and then I was trading 1,000 lots, right? So it's having confidence in your edge, right, and then being comfortable with the P&L swings, and so that's what I also try to explain, to my traders is, back then it was just trading firms or nothing. Nowadays you have all these trader funding companies that are popping up, right? It's such a gift to be able to trade and not trade your own money, because when you are trading your own money, you have no choice but to think of your P&L as real money, real world money terms, right? Because if you lose, if you're trading off money you can't afford to lose, then you can't pay your rent. That's real world money. Like, you don't react the same versus you have a firm backing you. So I was able to scale up, back to the original question, because I knew, I didn't want to lose, but I knew if for some reason I blew out, it's like, sorry, I'll see you. You know what I mean? It's like that frees up your mind to trade. So that's why, these trader funding, I know there are a dime a dozen now. There's one that I backed myself, that I put my name behind, Apex, but they're such a gift where you can get funded and you don't have to trade your own money, and it's just a whole different ballgame.
And that's why I've always liked, for beginners, I've liked sim trading in simulation, paper trading, just to get accustomed to market patterns and finding opportunity without real risk on. Because if you can't do the right things in simulation mode, there's no way in the heat of battle that you're going to do the right things.
Right.
So you learn when there's no risk, and then you gradually, like you're talking about, Scott, you gradually step up the risk in a doable fashion.
Right. I mean, you just put a post on this the other day. about, no, I forgot what I was going to say about practicing under real conditions. Like, it doesn't matter. You can read, this is your exact words. Like, you can take as many courses as you want. You can watch as many videos as you want. You can read as many books as you want. It's not the same as applying these things in real markets while they're moving, whether it's sim or not. Sim, of course, you're not going to react the same because in your mind, you still know it's not, you still know it's not real money. But that's what's also great about these trader funding things, where it's a very small amount, but it still hurts if you lose, right? If you I don't care if it's $50. If you got to pull out your credit card and put another $50 down, that hurts. So I think you'd be better off doing one of those than just straight sim. That's just my opinion. But you've got to practice under practice, not a game, practice, Allen Iverson. You got to practice under real conditions, right? It's like, you can't, courses to get the foundation, but then you got to get in there and get the experience. And this is what you wrote about in the Enhancing Trader Performance, right? How many hours did you say it takes to become proficient or expert at something?
Yeah, it's 10,000 according to the deliberate practice research.
Wow.
Yeah, it's amazing. It's amazing. I know we're moving on in time. There's a question about how professional traders and hedge funds deal with losing streaks and how to keep faithful to executing your strategy. Many times, if there is a losing streak or if they're losing in different markets, it's a sign that something has changed in markets. And so they're using that as information, and they may need to tweak their strategy. They don't keep doing the same thing all the time. And so that becomes information. If you have many different positions on and they're not working, multiple ones aren't working, that's information that maybe things have changed in markets that you need to adapt to.
All right. And there's another one in there by Laura giving you some props, I see.
Yeah, very nice. I appreciate that. But the stopping drinking and changing diet, losing weight, doing yoga, taking care of the body helps take care of the mind, gives us energy, helps us learn, helps us perform. It's all interconnected. So thanks for that. Awesome.
Well, so this was a great webinar to not really be trading, because we've been watching paint dry this entire time. Still long both these markets. And I mean, if I were a betting man, which I am, I will bet NASDAQ tags this liquidity by the close, depending on whether it does it now or in a little bit. Back to the games we were talking about. So I'm long both of these. I'm going to put my info in this chat too, if you guys want to learn more about me and the stuff I use in my trading room. That's all in that document. But Dr. Brett, thank you so much for coming on. I know how busy you are. I asked you last minute when, if you wanted to get on here, and you are usually, as usual, gracious with your time, and I really appreciate it. I know Bruce and the team at Bookmap appreciates it too.
Well, I appreciate the opportunity to speak with you, Scott, and speak with everyone, and look forward to coming back sometime in the future.
Awesome. And I'm looking forward to your new book too. Let us know when that's out.
I will definitely do that. Thank you.
Awesome. All right. Thanks. Thanks, everybody.
Okay. Have a good rest of the day. Bye-bye.
Bye.